Hello, welcome. As I said in my video a couple of days ago, step 3 of your annual health check was to form a market view. And as this was a slightly complicated topic, I've created today's video to discuss this in more detail for those who like a bit more detail. So let's get straight into it, as it's quite a fun topic. And please stick around to the end where I try to summarize this topic and share my own personal view for those interested in hearing it. Now, what was I talking about previously? Assessing the market valuation for the markets you are invested in versus the outlook and viewpoint you and other investors in that market have for that market. So how do we actually do this? Obviously, we can't see the future, but it's important to establish your own personal view so you can determine, as time passes and information comes to light, whether what is happening right now is still supporting your view and therefore you should remain invested as you are, or is the new information that is coming to your attention every day not supporting your view and therefore should you change your asset allocation? Now, this is basically portfolio management 101, folks. So what are some of the fundamental principles to discuss today? First, price of the asset today relative to history. Second, is earnings of the asset over the past 12 months relative to history, and of course, most importantly, expectations for earnings for the next 12 months and beyond. So these 2 points are basically the most important factors in determining valuation on an asset-specific micro scale. Of course, there are bigger issues like global politics, supply chain impacts, central banks, and a myriad of other issues which affect the entire macro market and should indeed be considered for both direct impact on earnings, but also the bigger picture of the macro impact. And by macro, I mean the entire market picture. So the entire debate is around how you complete this process and analysis for your specific time frame, and what estimates do you use and what issues do you consider. The countless issues that can come up will not be covered in this video today because the list is just too long, and I want to tailor it for what is relevant today in today's market conditions and where can most people begin this process. Obviously, more and more in-depth videos will be released over time, so hopefully this isn't too complicated or too lengthy, but it'll give you enough detail and enough of an explanation of the bigger picture on how to form your own view. So based on the complicated nature of completing these 2 steps, there is no real right or perfect way to complete each process. That is why so many different investors have different views, and one key reason we get volatility in asset prices, as all the different investors and traders are expressing their differing views and moving prices up and down, and that's what makes a market. Now, as I said in my very first video, I'll put a link up here to watch that, each investor's time frame is often different. And thus how you determine your market view for your investments is different based certainly on how long you plan to hold that investment, which is often different to everybody else. So, time to begin. First topic, assessing the price of the asset. One of the most juicy and heated topics. So where do we begin? Where many investors seem to focus, especially at the moment, and that is how far the market has moved in recent history. As I said in my last video a few days ago, up here for a link to that video, this can be quite a distraction in my opinion. It is of course important, but it also catches a lot of people out who get fixated on charts and how much it appears a stock or a market has moved. This is especially true as many people don't understand how large numbers affect stock charts over longer time periods. What does this mean? And why we should always look at them using a logarithmic scale to represent growth proportionately, as I mentioned in that last video. Now, I will try to illustrate this point on the S&P 500 over the past 10 years, where it has tripled in value. Although just know that triple is actually just an 11% compound annual return. Now, here is a line chart. Not using a logarithmic scale, and allow me to draw a straight trend line, somewhat arbitrary to use 10 years, but for example's sake it will do. as you can see, the chart clearly looks way above the trend, right, in recent time. Yikes! Quick, must be time to sell. But hold on, this is where many people panic and where many others scream bubble. Here is the same chart, but using a logarithmic scale. And what is a logarithmic scale, you say? This means that the chart will represent the gain from 2000 to 4000, which is a 100% return. It doubled, yay! Twice as large as the subsequent gain from 4000 to 6000, which by comparison is actually a 50% return. Whereas on the non-log chart, they are represented as the same change because in number terms, they are the same. 2000 point change and then another 2000 point change. But the market did not double again. So now allow me to draw the same straight, again, somewhat arbitrary 10-year trend line. And it's not so skewed towards the larger numbers now, as you can see. So this is how long-term charts should be represented, as a reference towards percentage change rather than number change. So be careful out there, folks. Obviously, the favorite thumbnail out there with this sort of topic is people, ripping their hair out, proclaiming some sort of doom. Now, many people obviously love screaming that panic because it helps get the views. But a prudent, knowledge-based long-term investing is really what brings wealth. So stick with me, and I'll continue to share what I can to break down this wonderful world of investing. So now you can see the two charts side by side. You can see that the log chart is a fairly linear growth line with the ups and downs of the short-term cycles, but otherwise a very similar growth trajectory over these 10 years. Whereas the non-log chart is skewed towards the larger numbers, which appears to look like too much growth in recent years and scares poorly informed investors. The example can be shown in a similar way over different time periods, just so you know. I've run this over many time periods. Now allow me to explain another way. All markets have trends, and they sometimes become overvalued or undervalued relative to their long-term trend. Sadly, they can also remain off-trend for a very long time. The famous market quote is, "The market can remain irrational longer than you can remain solvent." So always bear that in mind. But if we look back at the past and see where the market has come from and over what time period, we can assess where it is relative to history and its trend. So if we take the clearest example that everyone appears worried about right now, the S&P 500 has gone up by over 20% in 2024, which is about double the long-term trend of around 10 to 12%. But here's the key. Now look back 2 years. Sorry, what do we see now? It's gone up close to 50% since January 1, 2023 to January 1, 2025 in total price return. So what am I actually saying? And what is the key question here? The key question is, what's the compounded annual return over these 2 years? It is around 22%, which is again double the 10 to 12% compound annual long-term trend. So okay, there we are, 2 years of clearly outsized returns. Time to sell, right? Well, on that basis, we probably should have sold last year after just 1 year of outsized returns, right? And how wrong we would have been. But surely this year, after 2 years, over 20% is clearly a sell signal. Is it not? Well, again, you can't stop here. You've got to look back over many time periods. So let's look at 3 years. And there is where you will see a change. Just 29% total price return now. So boom, here we go. There was a decent correction in 2022. So what was the compounded return over the past 3 years? It is now actually 9% annually, and therefore back under our long-term trend. But we don't stop there. How about over a 5-year time horizon? You can see an 81% total price return. And that equates to about 13% compounded annually. Then we do 10 years, 192% total, but 11% compounded. One more just for fun, 20 years, 400% total price return. Compounded annually, 8.4%. Now this includes the enormous global financial crisis beginning around 2008 and continuing well beyond, when quantitative easing began on a ridiculously massive scale. Then obviously we had many regional crises since then, the European debt crisis being one, and of course COVID being the next major sort of global crisis we've had. Yet still here we are, largely on long-term 20-year trend. So now I've done the numbers for every year. The price trend has followed the growth trend. The world is growing economically, so the stock market is growing. So what does this mean for us right now today? Well, nothing is certain in this business, but I will say that all the folks out there pushing the chat of being in a market bubble and disaster just around the corner right now are somewhat right when looking over 1 to 2 year time horizon. But looking over anything longer than 2 years, the S&P 500 has produced quite close to an average annual return. So even after 2 years of over 20%, the 10-year trend is still just over 11%. And comparing the 10-year compounded growth trend to the most recent large down year, which was 2022, right before that year, which finished down over 13%, the 10-year trend going into that year was a little over 13% compounded annual growth. So it had maybe, you could argue, been a bit more overstretched, which was also the end of the aggressive turnaround from COVID, which was a bit of a over-exaggerated turnaround, became a little bit overstretched relative to the long-term trend. So while that created the 13% pullback in 2022, we're not in the same price position today, January 18, 2025. But does it mean we are due for a correction? Well, who knows? Nobody can see the future. But purely on a market price performance relative to trend question, which everybody seems to get a bee in their bonnet over, especially at the moment, and there's a strong argument to say the market is largely on trend at the moment, certainly within the trend channel, even if towards the top of it, but within the trend, and not excessive and way above the trend, like the dot-com bubble, for example. So in my very humble opinion, any pullback over the coming months is very likely to be bought by long-term investors who look more so at the long-term trend, and therefore probably not be a pullback for long. We also have had a record amount of inflation in recent years, but that has almost returned to trend of around 2 to 3% now. Now, I doubt I need to tell anyone inflation has been well above trend. We're all seeing it. Now, having it return to trend and allowing interest rates to now come down a little is typically a positive economic step for stocks, especially growth stocks. Now, whether they stay where they are, who knows? So anyway, after all of that, you should hopefully be able to begin to form your own view for your time frame based on the P price side of the PE multiple. So what is next? And what is equally, if not more important than price? Well, the other half of the most famous equation in valuation terms, of course, the E in the PE, meaning earnings. So for price to make any real sense, it has to be referenced against something like sales or growth or earnings, and earnings is the most common reference. So where do we stand if we look at the earnings side? The S&P 500 is roughly trading around 29-30 times trailing earnings. Now with the long-term average around 20 times, with a very broad PE range of 10 times at the cheaper end and 30 times at the more expensive end, using a 1 standard deviation of past performance. Now obviously it goes beyond 30 and below 10, but that's more rare. So based on trailing earnings, the S&P 500 is clearly at the top end of the earnings relative to history, right? But what do I mean by trailing earnings? This is actually a key point. When compared to S&P earnings over the prior 12 months, the price of the S&P today is about 29-30 times, as I said. But should we be valuing it against prior earnings over the prior 12 months or earnings over the coming 12 months? We should almost always be referring to future earnings, as the whole point of the stock market and valuing any asset is to assess its value today based on its future potential. So while historical earnings is important, by far what matters is future earnings. So whenever you see a PE multiple, you need to be sure it is based on the future 12 months of earnings. Now, what is the key problem with focusing on future earnings? Nobody can see the future, and therefore future earnings are always based on estimates, and thus there is variation, debate, and difference as each analyst, research house, and portfolio manager has a different estimate. It is of course based on information each company shares, officially called their guidance, but not every company gives guidance. And even the ones that do, it's often a little biased, maybe underestimated to help management look good by being able to then beat their guidance. Although each management team is a bit different, so there's not one rule for them all. Plus, all that said, even companies themselves cannot see the future and base their own guidance on estimates. Clearly somewhat informed based on what they know is coming in their pipeline for future sales or new product launches or whatever, but estimates nonetheless. And I haven't even pointed out that most guidance is only for the coming quarter, and we need to forecast future earnings for the entire year, or even more ideally. Yeah, exactly. So what hope do we have? But here we are, all trying to estimate current value based on future estimated earnings, when countless future events will likely have a material impact on those future earnings. So that's kind of how the earnings side of the equation works. A bit messy, right? But anyway, that is the best system we have. And that's what creates so much debate. But surprisingly, whether we look at it for a stock or for the entire market, the estimates are often pretty good. Then each quarter, a company releases updated numbers, what happened in the prior quarter. So then you compare your estimates to your actual. They also give you new information so you can update your estimates for the next quarter. They often then give guidance for that next quarter, and often therefore the whole rolling 12-month forward estimates gets updated. And therefore, so should your view. Asking yourself, is my view still in line with the new information? Hence the 4 earnings cycles which occur each year create the most volatility, as all the estimates and therefore each individual investor's views are changing. So back to the question though, where are we now? And what is the current earnings estimate for the S&P 500 for 2025, officially called forward earnings? Knowing it is all based on estimates, the estimates I have put the market around a valuation of 21 to 23 times forward earnings, which is a little above the long-term trend of around 20 times I mentioned earlier, but not by much. So there we have it. We have price roughly on trend historically, edging towards the top end of its channel, and future earnings roughly on trend historically, maybe a little high, and yet many people are calling for some crazy bubble to pop. But based on the fundamentals, I seriously call the bubble theory into question. But who am I? So all that said, as I've said repeatedly, most investors should realize that timing the market is typically not the best long-term strategy. Time in the market, not timing the market, is generally better for most who are just trying to save and invest regularly for their future. If you are forming a bearish view, meaning you're wanting to sell at the moment, then I recommend you evaluate 2 key things before you do anything. First, how much cash do you want as a proportion of your portfolio? If you're a long-term investor, then going to less than 60 or 70% invested is generally quite risky for any significant amount of time. That's in my opinion, as evidenced by what Buffett's doing. He's still 70% invested and has 30% cash which is a record amount of cash, and he's been doing it for 60 odd years. Whereas if you need to withdraw the money for some large purchase, a house or any other large expense, then that capital is not really dedicated long-term invested capital, and you're in a kind of different category. But if it is long-term capital, then you need to seriously think about what ratio you want to go to cash. And second, you must decide how long do you want to be out of the market for, and therefore also what triggers, what are you looking for, what are you waiting for to go back to 100% invested. This is key, as being out and missing getting back in at a lower price, or even an equal price factoring in taxes, can be just as bad as selling at the lows on a panic. Now this is important to stress. When you're selling, trying to time the market, meaning you're expecting it to go down, you've got to factor in your taxes on any realized gains. So that's baking in, it has to move at least by the amount that you're being taxed, because otherwise your amount of capital would still be invested pre-tax. You also need to factor in that markets sometimes track sideways, and a market tracking sideways but over time is actually a market going down or improving its valuation metrics, because typically earnings are continuing to grow, and therefore if it's not being baked into price, then the multiple, as earnings grow and price remains level, your multiple is actually coming down. So you don't actually have to see the price go down for the valuation to get cheaper. And this, most people don't quite grasp. Now, the other key point worth stressing along this same line is a loss is not really a loss until it's realized. So even if you miss timing this little downturn that people are talking about, it's not really a loss unless it stays down there forever, which is highly unlikely, or you realize it at that point. But if you're a long-term investor, then why would you be realizing it down there? Surely, as I've said in my other videos, you would be following what I typically recommend is the best approach, and what most long-term investors, experienced investors, think is the best approach, is investing regularly and ideally being a contrarian. So buy when everyone else is selling. So if a 15-20% decent pullback comes, you add more down there. You don't sell what's already invested. You leave that for the long term. Maybe a little, maybe you raise capital like Buffett's doing, 10, 20, 30%. So you're ready to put even more in on this pullback. But you have to be aware of everything I've just said. If it doesn't come, then you're losing money and you have tax to pay. So you're losing capital based on the tax that you must pay. So it's a bit more complicated than just selling and buying. Timing there's many layers to it. So as I said, be contrarian. Add double or even triple your regular amounts when these downturns come. Keep your capital mostly invested, 80, 90%, whatever. And then add more during those months of pullback. And this will help enhance your long-term overall returns. And of course, assuming you're a very long-term investor, and your view is still holding true, and that is the key fundamental view that all long-term investors largely hold, that the US and the global market will continue to succeed. Now, as a side note, it's worth bearing in mind what your fellow investors are thinking and making decisions on. Right now, many investors, as I've alluded to in this video, appear very worried about the 50% return over the past 2 years, and that likely means there'll be increased volatility as the debate of different investors plays out. Now, I hope I've addressed some of those points in the earlier part of this video, and we've seen that volatility recently. And maybe even a pullback until this sort of noise settles down and the majority return to focus on the more long-term view and long-term trend and all the points that I've already highlighted in earlier parts of this video. Also bearing in mind the impact of reduced inflation relative to recent years, and thus likely or at least stable interest rates. And then everyone goes back to focusing on earnings and earnings growth and multiples and etc., which is the fundamental point of this video. And earnings growth is looking somewhat strong at the moment. So finally, in summary, look at the price trend over multiple time periods, 1 year, 2 years, 3, 5, 10, even 20 years or more. Be careful with long-term charts. Ensure you use a logarithmic scale to proportionately represent returns in percentage terms as when the numbers grow larger, they can be deceiving on a chart. Then, assess earnings based on future, known as forward, estimates, and review and update those estimates each quarter along with the quarterly earning cycles. Or just read the internet and let other people do the numbers, but keep on top of it at those quarterly earning cycles. And beware of all the doomsayers focusing on the short-term sound bites and half-truths. Of course, markets most certainly go down just like they go up. The famous market quote is bulls go up the stairs and bears jump out the window, meaning markets go up somewhat slowly, step by step, and markets go down somewhat quickly, falling out of the window. Obviously somewhat self-explanatory. Finally, for anyone still watching, nice to have you here. As promised, perhaps you are asking, what is my view for 2025? First, it is worth mentioning that outside of the million things that can happen between now and tomorrow and every day after that, with strong earnings growth currently forecast for this year, albeit that strong growth forecast has been dampening with the earnings which have been released over recent weeks, I currently have my base case outcome for a slightly below average 7 to 10% market return this year. So that would mean we see the S&P 500 close out the year around 6,400 or 6,600. But obviously, who am I to proclaim the future? And of course, this is not financial advice and just my humble opinion. And every day new information, earnings, political decisions, etc. occur, which can make my and any opinion completely null and void in an instant. Also worth adding that with Trump's second term beginning next week, and global politics and wars and the rest where they are, plus trade wars on the precipice of kicking off, there are many known wildcards in play. And obviously also so many unknown wildcards yet and likely to play out. So that means I would expect more volatility this year due to the increased uncertainty of so many wildcards in play. But like any year, there are often pullbacks. On average, from the year high to the year low, it's not uncommon to see a 10 or 15% pullback. And certainly 2 to 3 mild kind of 5% pullbacks throughout the year. So in my view, for this year, with the likely increased headline risk of a Trump presidency, I see a higher probability of it being a year with one of those 10 or 15% pullbacks, and more likely probably in the first half because of all the noise which is currently out there. Now that's based on the information available today. I think that would present a great buying opportunity personally, and therefore where the market is likely to find strong support and still end the year around the 6,500 point. So there may be some above average bargain hunting opportunities this year. Perhaps that's what Buffett's thinking as well. So as always, it's wise to be ready to consider adding a little more than usual during those times. So good luck out there, folks. Thanks so much for watching. I really appreciate you watching this far. I hope you found today's video interesting and useful. It's one of my favorite topics to discuss and debate, and I really feel like I've only just started to scratch the surface on how to form a market view. So please consider hitting the thumbs up and subscribing and even sharing this video, as most importantly, it's free to do so. And it is therefore the best free way for you to support my work. And it really helps tell YouTube to share this content to more people. And the whole reason I'm sharing this is to help educate as many people as possible with quality financial education. So thanks for your help. I really appreciate the support. See you in the next video.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.